everyone. Welcome. Welcome. Settle in. We'll just wait for a few more people to come in before we start. But thank you so much for joining us today as we have this webinar on options trading with NASDAQ and Futu. So just make yourself comfortable and we'll start in about 1 to 2 minutes. And we see a few more people joining in. Welcome, everyone. Welcome to today's webinar on options trading. We're really excited for today's panel discussion, and we hope today you will gain as much knowledge from it as I will. I'm ready to learn. All right. Okay, welcome, everyone. Thank you for joining us today for today's webinar on options trading. I'm Olivia Higgins, and I'm the presenter for today, representing Futu Singapore. Now, a little bit about today's webinar. This is a joint webinar organized by NASDAQ and Futu, the Moomoo trading app. Today, we are presenting a well talked about topic, options trading. Now, before we begin, a little housekeeping rules, okay? You have to ask any questions through the Moomoo app or through our Zoom chat box. And if you can, put the name of the person you like to direct the question to. And then at the end of our panel discussion, we will open up the floor for Q&A, and they will answer any of your hot questions. So yeah, ultimately today we want you to gain knowledge and give you the building blocks on how to trade with options and ultimately improve your financial literacy and use this as an educational platform. We hope that you're just as excited as we are. So get your notes ready and do ask any questions at the end. So our topic for today, options trading, titled An Investing Strategy for Uncertain Market Conditions. This is a particularly important one as we navigate the unprecedented changes throughout the COVID-19 world. Now, we will discuss a variety of different angles. 1, what are options? 2, how has options trading evolved during the COVID-19 pandemic? 3, most common strategies for options trading during times of market volatility. And 4, how to utilize your option strategy to protect your investment portfolio. And at the end, we will do some resources and tools on Moomoo to do any smarter trading with options. Now we've got a list of 3 experts from NASDAQ and Futu today who will cover the benefits and risks associated with options, as well as how you can best formulate your own investment strategy. So let me start with our 2 speakers today, joining us from NASDAQ. Hi, John Black and Greg Ferrari. Hi, John. Hi, Greg.
Hello, Olivia. How are you?
Hi, good.
Good evening. Good evening, Olivia. How are you?
Good evening from here, and good morning to both of you over there. Thank you so much for joining us today. I'm just going to do a short introduction for you before we begin our panel discussion. So John Black, he serves as NASDAQ's head of index options product development. He leads the team responsible for enhancing and managing NASDAQ's index options product suite. including NASDAQ 100 index options, NDX, NQX, and XND. Next, we have Greg Ferrari, and he is the VP of Options Product Development for NASDAQ's Global Trading and Market Services. Greg joined the company after spending 3 years at the International Securities Exchange in business development function, and was also the VP at the Bank of America Security in product development. So, Greg and John, let's start with the core question. What are options?
Here, I'll take a quick stab at it for the listeners. When we ask what are options, options are a contract and they provide the right but not the obligation to buy a security or an underlying stock. So that would be a call option. And then a put option on the other side of the trade is a right but an obligation, but a right but not an obligation to sell a security. Contract, and each options contract has an expiration date and a strike price in the future.
Would you like to add anything else?
Yeah, I mean, to complement what John described as the baseline components of the contract, sort of the hallmark principles of the listed option markets in the United States is you have a what you see is what you get market. So you have market makers that have an obligation to provide continuous liquidity into the market, and they provide a bid and an offer that we stream through the NASDAQ platform. And the contracts that John described essentially enable investors to be able to achieve with certainty a price target for which options they wish to select. So liquidity and strike selection are key sort of hallmark principles in the deliverable of a seamless experience to the end user. So while if we were to draft a contract on a piece of paper, you may negotiate back and forth. It was something that was very much a highly designed sort of structured product. But with listed options here, what you see on the screen on the Moomoo app is the price that you're almost guaranteed, by way of the enablement and the scale of our infrastructure and technology through the global capital markets. So, the contract deliverable itself enables you to facilitate your entry into these products.
Great. So how has options trading evolved throughout the COVID-19 pandemic?
So I'll take a start at that and then pass to John. Tremendous growth in the asset class, a lot of different investor types, notably newer investors have really gravitated towards options. And by way of that, options provides a lower notional entry point into a particular asset. So there are, tremendous companies, global companies that have their shares listed in the United States, and we as an exchange provide the ability to have options on them. So with Amazon at a $3,500 US stock, for one share, to trade 100 shares of Amazon, that's $350,000 US, and that's a significant amount of money for a Reg T margin account. So with options, obviously having multiple expiration dates in a term structure, it gives participants a much lower cost entry point that represents 100 shares without true ownership. And then you have the ability to directionally position yourself accordingly based on your portfolio and your desired outcome. And so I'm going to pass to John here, who has a great chart illustrating some of the growth that we're seeing in the market.
Yeah, I think when we talk about the evolution of the marketplace, Olivia, it's really important to recognize, especially going through the last 2 years, that the industry has really grown over the last 30 years, but slowly. And then it kind of stalled out for 10 to 15 years. And then in the last two, when there was a work from home culture evolving through the pandemic, I think people had time to focus on their investment portfolios and look at new ways to protect their portfolio as the market moved. And we really saw the advent of the retail trader, much like some of the folks probably listening to this call. So as you can see in 2020, the volumes really started to grow, and it continued through 2021. At NASDAQ, we feel that this volume is now here, that folks have learned different strategies and different ways to utilize options. And we feel that that's going to continue, and it's our responsibility as an exchange to educate and to to keep this volume and let people know how to use them properly.
Yeah, a couple other trends that we're seeing. We're seeing more interest in trading shorter duration contracts. So, we about 7, 8, 9 years ago listed weekly options. So that was consecutive Friday expirations out to 7 weeks. So having multiple iterations. That now makes up over half of the volume in the industry today, right? In terms of short-term trading. So in the first or second Friday. So clearly, whether that's a covered call strategy and a constant role of a yield enhancing strategy, or downside protection in having ownership of puts and rolling those to the next expiration, we're seeing a lot more of that activity. In our most liquid ETF contract, so that's the S&P 500 SPY contract, that's the NASDAQ 100 QQQ contract, and the Russell 2000 IWM contract, we have expirations on a Monday, a Wednesday, and a Friday in the short-term structured component. And so now we're seeing about 1/3 of the volume that it trades within the weekly series being on a Monday or a Wednesday. And so we're really encouraged by that type of, let's call it directional short-term behavior shift, because it gives a very targeted outcome, whether that's overnight risk for earnings or weekend risk in terms of managing portfolio. We're definitely seeing a lot more momentum from retail investors trading in those alternative tenors. Another trend here is additional names that are getting a lot of interest. So we had over 1,000 IPOs this year, about half of them via SPACs. And the rule set for options on IPOs is after the 5th trading day, you can, and if it meets our listings criteria, we then are able to list options on that. And so there's been a plethora of new issuance into the market, over 300 billion of capital raised in the US alone. And so with that, you've introduced over 800 securities that have options on them on those 1,000 IPOs. And now there's just a tremendous amount of retail and institutional participation in those securities that's helping grow the overall pie as well. So, 5 years ago or so, it was very heavily concentrated the volume in, the top 30, 40, 50 names. And now with over 5,000 securities having options and over 800 this year, you're definitely seeing broader participation across a swath of securities that have truly helped amplify returns for investors.
Okay. So just a quick question, how can I use option to hedge downside risks?
Here, I'll jump in there. That's a great question here. I'm going to share my screen one more time, Olivia. Hopefully this will be a little bit helpful as a visual.
Sure.
First, NASDAQ, we also have disclaimers for both our indexes and our options. Options have inherent risk. Everybody should read the options disclosure document that comes with your account, just to make sure that they're not suitable for every account. But once you read that disclosure document and are educated properly, they're a great tool for, like you said, risk mitigation and yield enhancement. So then here, just for a visual, I'm going to go, and this website will be available to everybody after the call, but we've built out education to options. And when we talk about puts and calls, puts are a great way to hedge, mitigate downside risk. And that's the right to sell a security at a strike in the future, at a certain date. Okay, so all of these things, like we said, options have a premium, and that's the price you're going to pay to own that option. The strike price is the agreed upon price in the future of where you think that, if you want to sell a security at a certain price that's lower, you might buy a put option. An expiration date sets the target date for that option to expire. I think Young Sharon will demonstrate that in the Moomoo app later on, but these are things to think about when you're setting up your trades or you're looking to mitigate your downside risk. These are really basic strategies, but a buyer of an option pays the premium for the option, which has the strike and the expiration on a certain security or index. The seller of the option will collect that premium. So these are just the different types of ways to and strategies that one could use on options. There's calls versus puts. Like we said, if you want to participate in the upside but don't want to put the full value of the stock into that security, you may buy a call option that has a strike price higher than where the stock is trading, or lower. If you depending on what your appetite for risk is, we should reiterate that an option is just that, an option to buy the security. So if the strike is, we have in the money, out of the money, and at the money. So if something is in the money, the strike on a call is lower than the stock price of the stock. If it's out of the money, the price of the strike is higher than the price of the stock. Options can expire worthless. If you pay the premium and it does not hit the strike price, you don't have the money that you paid for the premium for the option, but you don't have to pay the full value of the stock. So these are some of the characteristics of options and how they work. I strongly encourage everybody on this call. It's very difficult to explain all of these things in one 35-minute session, trying to cover the whole options market, but the information is out there. The very important parts we're talking through. The strike price, the expiration date, the security, the underlying, the premium is important, how much you're paying. All options have a 100 multiplier. So if you buy a $1 option, it's $100 that's coming out of your account, and it represents 100 shares.
One thing I want to add to that is the notion that John described, which is time decay, really. So as options get closer to expiration, you see a frenetic movement in the prices that you'll see on your screen from the application, because there's all these sort of variables that you use to price an option from sophisticated market makers to be able to provide that continuous liquidity into the market. But time decay is probably one of the hardest things for you to project specifically, of what will an option be worth, in the future relative to where you are right now. So, rule of advice is, if you look at the delta of an option is really to help really give you a guide around the probability of that option being worth something in the future, right? So if it's an out of the money option, it still has value because it still has time left, right? Even though it's underneath the strike price in terms of the asset, the delta is just almost a simple guide of saying, for a $1 movement in the underlying, what will my option move in correlation to that? So when you think about managing portfolio risk, how do you correlate the option that you're looking to purchase relative to the assets that you have? So having single stock concentration, and then ultimately having an option that protects you, you have to be able to try to navigate sort of the complexities of the market vis-a-vis sort of your time horizon. So just be weary of that, and because not everything will line up perfectly for when sort of market timing and market events take place, relative to your quote unquote portfolio insurance. So definitely be weary of how time decay plays an active role in pricing these options.
Right. Thank you, Greg, for that. I'm just going to touch on that delta hedging point. Just for the audience, a core question: how do I apply delta hedging using option?
Sorry, you cut out a second there, but I think you said, how do you apply delta hedging to trading options?
Yes.
I think that adds a little bit of complexity of the delta hedging. Let's just talk about what is the delta. If we're explaining what a call or a put is today, I feel like there's just more background education required around what are the Greeks and how do they fit into managing a portfolio. And so I think of just the there's tremendous amount of content available through the trading community, through different platforms, including Moomoo. So I highly encourage you to get fully educated on all the different Greeks and how they help you manage risk and mitigate risk, if you will. But I think of delta in a very simplistic term, which obviously has a lot more characteristics to it, but is sort of the rate of change and the probability of your option being worth something upon expiration. So if you see a 30 delta option that you're buying, you're essentially protecting yourself for 30 shares, if you think about it like that, right? So while the contract represents 100 shares of you to employ that, to say, I have the right to sell that put option, it's delta hedging. Essentially, when a market maker is on the other side of your trade, they're more or less coming out neutral to then cover themselves for 30 shares, roughly speaking, in that instance. If they only did one trade for the entire day, that's what they would do. They would protect themselves on those, essentially that risk of 30 shares. But when you're buying or selling an option, you should be thinking about it as the probability of that option being worth something by the time of the expiration, right? So for that instance, your simple math formula would be, for a dollar movement in the underlying, my option in this example would move 30 cents.
Thank you, Greg.
John, I'm sure there's much more sort of elaborate explanation for that, but in terms of the who we're talking to, I wanted to try to simplify for them.
Yeah, I think in the simplest terms, those are the two right ideas as far as the rate of change of the relationship between the stock and the option and the rate of change, and then the percentage likelihood of that option paying out. So as the value of the stock goes up, right, the delta will go up based for the strike, right? So and conversely for the put.
Okay.
I'd stick to that for now. There's a lot of good information out there.
Yes. Thank you for clarifying that. I think this is the perfect time to lead into the next question, which is something that John himself touched on, is what are the most common strategies for options trading, especially during times of market volatility?
Okay,
Yeah,
I can
yeah, go ahead, John.
I can
Yep.
yeah, no, I could take a stab at it. To start, we really want to stick to the basics, and it's, when we talked about calls and puts, there's a long call, a long put, and then short call, short put, and those are some of the building blocks of option strategies. And it depends on your viewpoint. It depends on what you're looking to do for your portfolio. Again, Greg and I we work for the exchange. We help provide a fair and equitable marketplace for these transactions to occur. We're not advisors and aren't giving advice here. It's just for educational purposes, like we said. But a long call would be a chance to participate on the upside of a stock. As the stock goes up and you're long a call, the value of the call will go up. A long put would mean you own the put and you're protecting a portion of your portfolio if the stock were to go down. So that kind of strategy, if you have a concentrated position in Microsoft or Apple, Facebook, a single stock, and you want to make sure that you protect the gains that you've made in your stock, you would buy a put, and that would protect it. If it goes down, then you have a right to sell your stock at a certain price. And then on the opposite side, if you were to sell those strategies, sell a call, sell a put, those would be yield enhancement, where you're collecting the premiums because you don't think the stock is going to go past a certain point, or you're okay selling it there or buying that stock at that lower point if you're sold a put. A put can be looked at, if you're buying a put, as an insurance policy. There's a lot of folks that buy puts that never want to see that put exercise the strike price because they don't want the stock to come in, but they're protecting the downside. So it's almost like an insurance policy. A short call can be looked at similar to a yield from a bond. If you own an underlying stock and then you sell or you write a call, you're collecting the value of that, the premium from that call, and you can apply it to the value of your stock, right? Like if you own 100 shares of XYZ stock and you sell calls on it every month, then and you're comfortable selling the stock at that level, then you are collecting those, call it coupon payments, or what would be like a bond. And I think we might see a little bit of some of those strategies on the Moomoo app later. Greg, is there anything that you wanted to add there?
Yeah, on the covered call, I mean, it's probably the simplest of strategies because you already own the shares, you already have a conviction that you like the company, or you're directionally focused on the output of what you own. And to John's point, selling an out of the money call on that long stock position enhances your yield, typically on, whether it doesn't pay a dividend or does have a dividend, that you could essentially enhance your performance, but up to the strike. So in the instance where, you have, let's just look at, Facebook is a $335 stock, you have 100 shares of that, it's, roughly $33,000 of a concentrated position. Someone may want to sell a call and then buy a put, for instance. So you use the upside of selling the call to finance, having the downside protection for a dramatic single stock move. And then we call that a collar as an example. So that's a little bit more advanced, but how do you use one option vis-a-vis another option to essentially lock in gains and then, protect, your portfolio in the instance of a sudden move in the market? So we're seeing a lot more of that behavior of how one option trade leads to another option trade. And then ultimately, when things start to evolve in the market, how do I then reposition my portfolio so that, based on market conditions, that I have the ability to have the next dated contract that enables me to achieve my financial objectives.
Great, thank you for that. I think on that topic about covered call, Yong Sharon himself, who is the dealer from Futu Singapore, would you like to add any of your thoughts on this?
Thank you, Olivia. Yes, definitely. So from Mumu perspective, covered call is very popular strategy with us, and a lot of clients actually they sign up for this. In Singapore context, covered call is just like you own a property such as a condo with condo, and you list your condo to Property Guru or any. I'm not promoting Property Guru, of course, but to a property listing website to sell a property at higher price, which is the out of money call options. And you also collect some rentals while you are waiting for your property to be sold. But this doesn't mean that your property will be sold definitely, because you are trying to sell at a very high price for out of money call options.
Okay. I've just got a question. Should I see call option or buy put option if my market view is negative, for example?
So think of if you buy a put outright, right? It's just essentially think of it as either like homeowners insurance or car insurance. You're constantly paying to protect yourself. And so if you have a bearish view and it did not realize that outcome did not, take hold, then ultimately you're constantly paying for the insurance without realizing the benefit of that insurance, of owning that insurance. So the selling of the call and then also buying the put, it enables you to lower your cost of buying the insurance given your directional view, either that's more macro focused or specific to an earnings event or specific to something that may happen in the market. So that is just becoming a much more popular strategy, is how do you finance your directional bias, and then how do you use the options market to do so.
Would you like to add anything, John?
No, I think Greg summed it up pretty well there.
Perfect, thank you. Yeah, I would love to know how to utilize, my option strategy, for example, to best protect an investment portfolio. Maybe you can tell our audience some of the ways we can go about this.
Yeah, so what we're seeing is very popular is more broad-based portfolio management. And so utilizing index options, specifically what we see is the NASDAQ 100, which represents the largest non-financial growth companies globally and that are listed on NASDAQ. So you have a swath of securities. So that is Apple, Amazon, Tesla, Microsoft, Google, et cetera, all in one security, so packaged. So that enables you to have broad coverage but what's also driving the market outperformance. So we're seeing a lot of investor demand to say, how can I use this throughout many different market cycles, market conditions? And in John's bio, you rattled off a few securities that represent all different NASDAQ 100 type instruments. And those are all essentially notionally appropriately sized based on the investor, sort of appetite for how much capital outlay they have. And so we basically try to figure out how can we create the right products for the right demographics in order to realize the same benefits, which what index options provide, whether that's on the upside or the downside through different market conditions. John's definitely the expert. He spends a lot of time working with institutions and market practitioners. And so I'd love to hear what he has to say for newer investors in terms of investor protection.
Yeah, I think that when we think of a whole portfolio, you're going to want to look at some of those broad-based products. There are some ETF products out there that, such as, there's index-based ETFs that trade like single stocks. So, like for example, if you had a number of the names in the index that Greg referenced, the NASDAQ 100, if you had some of the FANG names or some of those higher tech names, you might want to hedge with something like a QQQ ETF or some other technology ETF. Again, suitability, what the construction looks like. You're really going to want to do your homework and see the correlation between the ETF and your portfolio. But looking at what is your tolerance for risk and what is your appetite for the strike price. Do you want to see your portfolio protected 95% downside or 5% downside, 10% downside, 15%? Like, you would have to look at your portfolio, figure out what your comfort is, how much you want to spend in premium to protect it. So those are different ways and different tools. Like Greg said, I manage our index options at NASDAQ, and those are cash settled products where there's no exercise risk. So that's an important part of options that we should probably talk about real quick, in that single stock equity and ETF options have an exercise where if the holder of that option would like to exercise their right to buy or sell the security, they can do that anytime during the life of that option. So if you're long a put or a call and you want to exercise your right at any time, it's called American style expiry, which means you can do it any time through the life of that option. As the person that writes or sells that option, they might have to deliver the shares or have the shares taken away from their account. So they have to be prepared for that for American style. The products that I manage are European style. They're cash settled and they only can be exercised at expiration. So to go back to your original question, Olivia, about portfolio management, the cash settled index options provide some useful tools for the investor, where it's almost like a set it and forget it. If you buy these downside puts and set them quarterly, you have that protection through the quarter, and then maybe you buy the next quarter out or the next quarter, or you can do it on a monthly or weekly basis, depending on how you want to protect your portfolio. So that there's a lot of flexibility with index options that here in the US, folks are starting to employ. So we have different sizes, different expiries from a NASDAQ standpoint. There's other products out in the marketplace that can be used as well, depending on the portfolio construct. But for downside protection, in the easiest of terms, it's put buying, maybe financing with a call selling.
Okay, just to recap for the audience, especially the ones that joined us, we're referring to NDX, NQX, and XND, yes?
That's correct.
That's
Very, very, very good. Those options are the flagship or original contracts are the NDX contract, which is a higher notional product. It's a $16,000 index, so it's $1.6 million of notional coverage per contract. And just over, since my time at NASDAQ, it's gone from 6,000 to 16,000. We did a 1/5 the size notional value, which is NQX,
Mhm.
3 or 4 years ago. And, that's about $3,200 of notional value, or 150,000 of notional. And that index is about 3,200. And then we just launched XND, which is a $160 notional product, which is great because then there's a total notional value of $16,000, and it's much more easy to manage for your average account size.
Absolutely.
So there's three different sizes, different strikes, different expiries, and then you configure all of those things to build portfolio protection based on your portfolio construct and size.
Yeah, some of the feedback from US based investors or new investors here is, I love the cash settled nature of your products. I have a day job, I have other things going on. I don't necessarily have the underlying QQQ asset, but I want to have portfolio protection for my holdings itself. So they may hold Apple and Amazon and Tesla and Microsoft in their account. And having the cash settled nature, you don't necessarily want to deliver into the ETF shares. You just want the actual momentum and protection vis-a-vis the actual assets in your portfolio. And so cash settled nature of that just gives you the inherent protection of the downside move of those products without actually have to worrying about physical delivery. And so that's one of the sort of the best use cases of it. And then John represented the European style as well. It's like having that peace of mind that something that can't be called away from me early based on a professional trader understanding some of the benefits of calling something early. As a newer investor, having this certainty of what the contract date means absolutely has inherent value. So not knowing what could or couldn't happen, whether that's a dividend or other sort of structural things happening in the market that someone may see that of value, knowing that can't be called away early is certainly a benefit to investors.
Thank you so much for that, John and Greg. Do you have any final thoughts before we move on to Yongshern?
I think that community-based trading and sharing information, with like-minded investors, and essentially utilizing a platform like Moomoo for responsible trading, who build the safeguards and the inherent protections in place so that you can have a great experience, essentially goes a long way. And we have a lot of product out there. We have over 1.5 million strikes. And so when you think and you close your eyes, you're like, wow, and you picture like a football stadium, and you think about every seat being a person. That's 15 different stadiums live of having a price in the market at any given point in time. So, thank you to our partners in Moomoo for obviously building the technology and the robust experience so that you can essentially entrust in the capital markets foundational delivery of these contracts each and every day that we all do work really hard at. And so, with that in mind, just continue to think through ways that you can evolve your learning and use your network to be able to constantly grow as investors.
Final thoughts on this. I think, Olivia, one of the important things is that that this was just 35 minutes to talk about the options industry. There is a vast array of education. NASDAQ, we've really entered the world of education in a big way in the last year. We do have a website for options trading. It's on MarketWise Asia, and it's a NASDAQ page where we have education, and we start from the building blocks of a put and a call, the strike, the expiry, all the stuff that we talked about here. It breaks it down. There's articles attached to it. There's different, there's going to be videos. So these are all things that, like, when I started in the options industry 15, 20 years ago, the tools available to the retail investor globally are better than the institutional tools that they were using then. So there's a lot of information. There's a lot of, we mentioned the Greeks, the different strategies. This is all available to the retail customer now. And I think that it's a good place for people to start if they're getting into it and want to learn how to hedge their portfolio, hedge a single stock position, start small, get to understand how options function, get to understand the product, but educate yourself. And I think that's the key to this. We don't want folks just diving in and just trying to get those small options to grow to millions of dollars. Like, actually understand the fundamentals of the options. They're a wonderful tool for risk mitigation, yield enhancement, portfolio protection. And I think that what Moomoo and Futu and NASDAQ are all doing, what we're trying to do is educate the proper use case. And that's why partnerships like this are so important to get that message out. So I'll leave it on that.
Thank you so much, John and Greg, for joining us. And I learned a thing or two myself. So I hope the rest of you also benefited from this just as much as I did. So yes, today, just to remind you, we're here to help you make better decisions. So we want you to keep learning. And so therefore, we're about to bring in Yong Shern, who will give us a live demo training in app. So how exactly can you start? I think it's important for us to now, go through a bit of training and show you how it actually works so that you can put together the theory and the practical elements together. So before we go on to that, I would like to introduce you to this rare opportunity that we have for December. And Moomoo themselves, they're going to give away a zero commission for options. And so this is quite rare at the moment. And I think for those of you who are in the webinar right now, definitely log on to the app and take a look for yourself. So that leads me to our last speaker, Yong Shern, who is a dealer who is responsible for options, equities, futures, and other Futu Singapore products. He also does product testing and platform enhancement. So as a subject matter expert, he is here to show you all the resources and tools to do smarter trading. The floor is yours, Yong Shern. Hi.
Thank you, Olivia. Hello, everyone. I'm Yong Shern. Now that you have learned about options trading from our panelists, in this data-driven era, analytical tools on trading platform are playing crucial roles in formulating your investing and options trading strategies. With Moomoo app, you will get to enjoy these features on your fingertips. In the next 10 minutes, I'll be showing you on how to use Moomoo trading app in a smarter way. Feel free to log into your Moomoo app to join me. Hello, everyone. I believe most of you are in your Moomoo app right now. So basically, you are in this watch list under quotes. This is considered as the main page. So feel free to go to your watch list and US market, pick one counter. Okay, let's choose this. At this top panel, click on the options. Now, by default, you'll be directed to option change. Option change show the options with different strike price and expiry date. There are a lot of functions to be utilized here. First thing you can look at is volume ratio. The volume ratio shows the ratio between the call options and the put options being traded in the previous trading day. As you can see, there's 68 against 32. 68 would be considered that the call options traded volume is higher than put options. This could mean that the market sentiment is towards the call options, and we could take a deeper analysis on this. Other than that, we have a filter function for you to customize the display of your options. Click on this, like what John and Greg have mentioned earlier. The options breaks are here available here. You can choose to display or hide it, and click confirm. Next, we have this panel also for filtration. Okay, now that we can filter by call and put options. Next, we have distributions. In this page, we are going to show you volume by strike price and open interest by strike price. You can filter based on expiration date, call put options, and total a combination between call and put. You can also share this to Moon community and other social media. Next, we have this volatility. You can see volatility term structure and volatility amount. If you want to know more about this, you can click on this information icon to view the definition and how to use it. You can filter by strike price, either for 3 or 4, call and put options. Yeah, that's for this page. Here comes my favorite page, unusual activities. In this page, you're going to get this data live during the trading hours. So you can get, this is calculated based on the open interest and traded volume in the exchange. So this is very important for you to craft your trading strategies, including you can detect those institution buyers or sellers in the market via this page. To further ease your access to this, you can filter down based on the watch list, and of course, it's the other, those stocks that you have been watching. You can filter down based on price and other information. All right. Lastly, we have this ranking page. This is ranked by the underlying counters, by volume, open interest, implied volatility, and many more. At the top right corner, you can see there are several icons here. For those who are looking to sell a call or long put options, you can also feel free to check this short margin icon if you were to exercise the option. Right, back to the option chains, and we can select one of these options to do a demo trading. Okay, in this page, we can see this detailed quote page for this specific option. This is a 1-minute chart, and this is very rare in the industry. We provide 1-minute chart for options to ease your trading. Before you start trading, you can go to this analysis page. Same, you can see volatility for this specific counter, for this specific option. And next, you have option P&L chart. This is the option payoff diagram, which is very useful for those who are doing covered call or they want to do single option or combination of different strategies. You can see your payout over here in this page. It's very easy to use, and probability of exercise. I think this was mentioned by our panelists earlier. This function is very important because you can get to see the estimated these options being exercised or expired in the money. And you can also see this historical probability. I personally do use this. This is not only important for options trader, but also important for those who are trading in stocks, because they can see about the price movements in the future to gauge, to provide some analysis, provide some insightful information. Okay, now back to the quotes page and begin our demo trading. For this step, I don't really encourage you to follow me because I'm going to place an order which is directly sent to the exchange. So you're not encouraged to follow me. Thank you. So in this page, you see this is the order page. First, you need to unlock to start your trading. Okay, you can see this is an option and price. For those who are not sure about the price, you are for Moomoo users, you are provided with this level 1 price. You can see the bid and ask quote over here. And in terms of quantity, you can see if you're unsure about how many options you can buy, you can always refer to this buy on cash quantity, buy on margin, sell on position if you are holding this specific option. And lastly is short sell quantity. This is very important for those who are going to sell naked call or naked put for income or for your trading strategies. Click on this $ for those who are looking to sell options, sell naked options, because you will be, margin will be required when placing a trade. You can always refer to this IM, initial margin. To sell this option, the margin required is about US dollar 4,486.88. All right, now let's place a trade. Right? Okay, yes. Upon placing a trade, you can check your order status via this trade page. Click into your US margin account. It will be under your position tab if the order is filled. Otherwise, it will be in this today's order page. Next, you can go to me for those who are looking through, not ready to start your options trading in live. You can always go to the paper trading platform. Click options, and you'll be given 1 million worth of US paper trading money to begin your trading, your options trading journey with us. That's all about it. Thank you so much for your time. Olivia, back to you.
Thank you, Yongshun. So we've come to the most exciting part of today's webinar, and that is the Q&A session. So we've looked at all your questions through the Moomoo app discussion box and Zoom chat. And yeah, I've got a list of questions for our 3 experts from today. And the first question, I'll just open it up to the floor, so any of you can take it as you wish. What are the benefits of using options from retail investors' perspective?
Sure,
I think the number, go ahead, John.
Oh, I was just going to say, I think the benefits are, when used correctly, options serve a great purpose to portfolios for risk mitigation and yield enhancement. And those are some of the themes we talked about. There's certainly the websites and the educational materials, but in simplest form, options provide opportunity to mitigate your risk to your portfolio and increase the yield on your securities. So when used correctly, options could be a great tool for portfolio management.
Yeah, I echo that sentiment. Yield enhancement and risk management, the key tenets of options trading. The other aspect that you should consider as the benefits, these are a lower notional entry point into or out of a security. So how do you use options to get into high-priced securities and directionally participate, in the upside or the downside movement of the underlying asset?
Sure. Yongshun, do you have anything to add?
I think, John, that was well answered. Thank you.
The next question is directed to Yongshun. What will be recommended as an option expiry duration for passive income strategies?
Thank you, Olivia. To me, I would say 2 weeks, but that depends on the particular underlying, whether the underlying has a monthly or a weekly expiry option. But if it has, then I think 2 weeks is perfect to me. Yes, you can sell a longer period of options, for example, sell or put, but you are exposed to higher risk, although you can collect a higher premium. So, if you were to sell a weekly option, the premium is very low. So I think 2 weeks is balanced, as you are able to, sell out of money call, and somehow you are exposed to lower risk and a stable income stream to your portfolio.
Thank you. Greg and John, do you have anything to add?
We agree. The shorter duration between the time of execution and the end of the expiration of the contract is gaining momentum and a lot of popularity, especially for passive investors. So I think of passive as looking at more yield enhancement as opposed to portfolio protection. So how do you constantly repeat that process? So through short-term, essentially upside call selling, passive investment, think of that as a dividend stream, an enhancement to your performance of your portfolio. You do that through selling upside calls. By way of doing that, you want to constantly repeat that outcome. So, we totally agree with the answer that Yongshun gave.
Our next question comes from the audience as well, from Moomoo app. Is it true that most option strategies revolve around profiting on major swings in stock price?
I think I'm gonna take a stab at that. I think the key word here is most option strategies. Like, we never want to say most.
Right.
It's how you're utilizing this product. And one thing we didn't talk about is speculation, and that is certainly a way that people utilize the options industry. Well, everything that we've talked about is the classic use cases for buying puts, buying calls, selling both of those. There are strategies that people employ that like try to take advantage of the major swings in the market, participating in the upside or buying the tails. So that is certainly a way people can utilize options. For purposes of this conversation, it was really for those entry level folks coming into the marketplace that want to know how to use options. But if, I would say that we talked about delta and the likelihood of things happening. So the farther you get away from the spot price of the stock or the current value of the stock, and you move to the strikes that are on the tails, the lower the delta of that happening. So if a strike that was at the same price as the stock was a 50 delta, it was 50% in the money, 50% could be out of the money, then the farther away you move is a lower delta for like a call. So to participate in that call strategy that's way out of the money has a very less likelihood of actually ending up in the money. So depending on how you look at the marketplace, like I would say that most of those options end up worthless on that far end of the spectrum. But if you're buying an in the money call and participating on the upside there, that might be a different strategy. So it really depends on how you look at it. But to say most option strategies, I think that might be the word that changes that statement.
Yeah, to key on what John said, most options do expire worthless, right? So that is a key theme for you to remember coming out of today's webinar. So when let's just using the example that Young-Shern referred to, if you're selling an option, 2 weeks out, if you've collected that premium and you have conviction that option will expire worthless, then you say you let it expire, right? But if you have essentially a risk of that actually being taking delivery of your shares, or if you're naked, now you have the ability to worry about what do I do in the event of going through expiration. You always have the ability to roll that to the next contract. So that's the beauty of the product set and the term structure, that these weekly products have consecutive weekly instruments available to you. So if you've essentially had a view and the market essentially disagreed with your view, you have the ability to course correct and find the right strike selection based on newer information that you have to be able to restate your thesis in the market. And so by way of most options expiring worthless, that means some options don't expire worthless. And having that go through the entire cycle of having to deliver cash or deliver stock through that event could be a daunting experience. So utilizing a roll is very important as a trading tool for young investors.
I would just add one last thing. As a lot of options expire worthless, or most in this case, there is a defined risk inherent to options where the purchaser of those options can only lose the amount of money that they put into the option. So if you buy a premium, you can't, if the stock goes down, if a stock goes to zero, you can only lose the amount of money that you paid for the premium of the option. So the risk is defined, but it could be everything that you paid for the option. So that's important.
Sure. Thank you so much for clarifying that. Our next question is directed to Greg and John. Does the increase in option trading have a bearing on the share prices of the counters?
I'd say mostly no, but to some degree, yes. And if it's all one-way directional option trading, market makers, there's been reported news around, sort of a gamma event or gamma selling. And so how does an option market maker run a delta neutral book? By way of that, they have to, if they're selling you a call that if an entire swath of investors together all buy the same strike in the same instrument, naturally market makers are trying to, hedge that risk accordingly by buying stock. So if that kind of continues that self-fulfilling prophecy, then naturally you see what happened back in January of this year, which had sort of excessive risk. So market makers have started pricing that into how they, put liquidity out in the market. So so that they could manage accordingly. So there's clearly, these are derivative securities. So the option price is derived off of the cash instrument. And so they're linked, but they do have their own sort of destiny, if you will.
Anything to add to that?
It's a really tough question. There's different, I think it's a philosophical question and it could get a lot broader, but the combination of the equity price plus all the derivatives around that equity get to the real price of that security. So they all influence each other, right? So like, I can't, it's a very big complex.
I'd say it's more interconnected than we think, but as spot prices of cash sort of deviate from their true value of, in terms of income statement generation or balance sheet or the true value of the company, the options themselves may have a better reflection of what the actual company is worth than the actual underlying itself. Right? But take that with a grain of salt, right? Because those providing liquidity into the market really understand sort of the fundamental math behind how to price these securities. And novice investors should stick to the basics and don't try to take on too much, because the market will tell you when you're wrong, right?
Right. Thank you for that. We have time for our last two questions. The next question is directed to Yongshun. So how is this sort of trading different from robo-advisors?
Robo-advisor.
Yes.
That's an interesting topic. Yes. For us as a fintech company, we provide trading platform. As by what we have mentioned earlier, your trading is not alone with us. You are community-based trading. So with this fintech technology for you to customize your portfolio, as it is different from robo-advisor. Robo-advisor provide you a suite of that fits your personal investment objective. Whereas for us, you can customize your portfolio based on your personal needs, and like I mentioned earlier, relate to the earlier question, you can also customize your time frame for options. So I would say customization is one of the core strategies if you are going to trade with us.
Okay. John and Greg, would you like to add to that?
Yeah, I'd say that systematic trading is definitely a growing trend in the market, and having these tools and technologies enabled for all investors, robo investing being one of them, is really enhancing participation from true all investors and how they sort of manage portfolio management, yield enhancement, and sort of directional trading. And so robo advisors are clearly taking in a lot of data, analyzing portfolios, analyzing trends, and being able to facilitate delivery, in some regards better than a human. But obviously having that hybrid approach is where we see a lot of the growing trends in the market.
Thank you. John, would you like to add? I'm sorry, I saw your mic.
No, I'm Greg answered. Same here.
Great. So that brings us to our last question, directed to anyone here. What sort of financial products are most popular, and which are the best outperformers for 2021?
There's so many good products. There's so many products, Olivia.
So
for a general question.
All right. So that is a great question. And I kind of stated it before, but from an exchange standpoint, we're not like advisors. We're not financial professionals in that regard. But that's the beauty of options. and what options provide and the tool that it is to portfolios and equity positions, it does mitigate risk, enhance yield, and options are agnostic to whether the market goes up or down. So they are a great tool to express your viewpoint. So if you have a portfolio of stocks that have appreciated over the last 18 months and you want to protect that gain but still participate, you can use the options to do so. You can write a call and generate income. You can buy a put and protect the downside. You can do a combination of the two. You can buy a call spread. You can sell a put spread. You can do all of these things with options based on your view for that equity position, portfolio position, index level. So options provided, it's more of an extension of the investment portfolio and what you can do with the product. So instead of looking at this as what's the market going to do, it's how can you set your portfolio up to capitalize on what you think the market's going to do. So that's what I'll say as far as product.
Yeah, I look at these as tools for navigating market complexity as almost like a market mechanic, right? So you have all these different tools to be able to adjust and finely tune exactly what your investment objectives are in an up market, in a down market, in a sideways market, in a very volatile market. And that's what's beautiful. The great thing about this asset class is that it's fairly dynamic and you're able to adjust very, very rapidly because all these things are available right at your fingertips through the Moomoo app, through the infrastructure that we've designed and developed, through the tremendous amount of liquidity that we have. So John is 1,000% right. We cannot give any specific recommendations, but your investment thesis and representing it through the tools that are available to you is how you will continue to evolve as investors.
To me, I totally agree with John and Greg. So from Moomoo perspective, Gen Z really are very keen into options trading, especially buying options. And for those very hot, for hot stocks in the market, and you can also utilize this hot stock function in Moomoo app to screen your stocks. And options, I believe the trading volume has grown up a lot because we have a lot of options in the market, equities, index options, and maybe futures options. So this really helps you to provide some hedging in your portfolio, and as well to customize the probability when you are selling call and put options. So I believe options should have a place in your portfolio.
Thank you, Yongshun. So gentlemen, that was a very, very good end to our webinar today. I would like to ask you if you have any last thoughts for our audience today watching, especially for 2022.
Yeah, we believe the retail investor has never been more empowered and never had a better experience. Strike selection, liquidity, and dynamic use of the tools to navigate the market are key things to remember today so that you can be empowered to perform in 2022.
I think it comes down to education, understanding the marketplace, and making educated decisions for your portfolio. There's plenty of information out there. I think that's the beauty of the Moomoo app, NASDAQ, partnerships like this where we can get the word out, educate on the product, proper use cases, all the use cases, and then drilling down and finding out what's best for your portfolio and protecting it and capitalizing on the marketplace. It's an open marketplace. The market structure lends itself well for investment choices, and we're happy to continue to provide that education through webinars like this and online education. So whatever folks need, we're there for, and we'll provide those websites to your team. So if anybody has any questions that's watching or wants to revisit some of these subjects, it's available to them. Thank you very much for the opportunity.
Yeah, thank you, Olivia. Thank you, Yongshun.
Thank you.
Happy to be a part of your community and continue to provide what we see here. And anytime that you guys want us back on, just let us know.
Thank you, John and Greg. I mean, your
Thank
sharing is very
you.
great for our investors.
So for the audience, we would like to thank you for being with us today. Thank you once again to John and Greg from NASDAQ and Yongshun from Futu Singapore for joining us as well. So we now want to end with letting you know that we've got future webinars in place for you. This is just the beginning of, a round of educational tools to help you get the building blocks to start with your investment strategies. So we look forward to the next webinar. More details will be in our Moomoo app. You can also follow our Instagram and Facebook for more updates. Again, if you want the 0% commission for options promotion for December, remember to head to the app right after this. Our team has also put any details in the Zoom chat. So if you have any additional questions after this webinar, feel free to message them, email them at webinar@futusg.com. That's webinar@futusg.com. Once again, I'm Olivia Higgins. Have a great evening or wherever you are in the world, and see you next time. Thank you, everyone.